Happy Friday. Hi, investors and traders. Todd Gordon, New Age Wealth Advisors, founder of Trading Analysis, former CEO. We are fiduciary wealth managers managing longer-term portfolios in a very volatile and interesting market here. It's Friday afternoon, 4:10. Happy Memorial Day. I just want to get this out, a few points to talk about. I don't expect anyone to be listening to this right now. If you are, congratulations. You're a hard worker or a dork like me. Just kidding. But yeah, just want to update you what's going on here. Pretty unbelievable comeback here after unbelievable, obviously, start to the year, and then we've had a very sharp bounce back. So just want to take you through the key things. Sorry, I look like a college kid here. Did play some, got out and played golf this morning, very early, teed off at 6:30 and got home, and I've been doing work all day. And after this, we'll post it up and get a jump on the holiday weekend. So hope you have a good one. All right, so let me show you what we're teed up with here today. There's the itinerary there on the right. Let me just flash up the closing. Pretty good session here today. I should be able to see that okay. So Nasdaq up 3.3%, unreal. Dow up 1.7%. Small cap Russell up 2.7%. VIX crushed, down 4%, down to 27. That's copper up a touch. Crude still hanging tough at 115. That continues to be problematic. Fixed income, this is 30s. These are 10s. These are 2s. 2-year treasuries, kind of mixed in there. TLT has come up off the low as well. Remember, those bond prices up, yields down. Looks like gold, as I always say, continues to be useless, right around 1,800 to $2,000, and that's that. Lumber and a few other guys as well. And the dollar off a touch. So good closing session there, and unbelievable move. So looks like I'm going to hit the market technicals number 2 on the list here today. I don't have a marker to kind of go down there. So. All right, so let's talk about the economic data. So we've had good earnings season here in Q1, and I'm relying on some data from FactSet here, and I've got some notes here. So almost all the companies, all but 5% of the companies have reported Q1 earnings, and here's how it's breaking down. It was a good earnings season. According to FactSet, which is sort of the go-to for data, 77% of companies reported earnings above estimates, okay? And it's actually equal to the 5-year average of 77%. And of those, let's call it 3/4 of the company that beat analyst expectations, they did so by an average of 4.7%. So they delivered more earnings by 4.7% on average. And this is interesting compared again to that 5-year average of about 8.9%. So usually the companies that beat, which again, 77% of companies on average, 5-year average beat, but this was right on track, but they beat by roughly half. Okay, and there's some interesting stats that I have here for you in a chart to show you how these companies have performed after the earnings beats. There's another part that is not so rosy here. The forward guidance from the analysts and from the companies has been negative, and that's been kind of weighing on the market a little bit. So revisions for Q2 right now, and here are the stats. 70% of the companies, which is of the S&P 500 companies, have issued negative guidance for Q2. Okay, 70%, and this is above the average of 60, 5-year average of 60%. So this is companies saying Q2 earnings are going to be weaker. Okay, so markets, I think we're forward looking and pricing that in. And in terms of analysts' expectations, okay, this isn't a company saying how much we're going to make. These are Wall Street analysts. They've cut the estimates for S&P 500 companies in Q2 by 1%. in aggregate, and that's relatively small. And FactSet goes on to make the point that the sort of the negative reaction is not so much this quarter's earnings, but again, it's the guidance that has been dropped, pretty significantly. So that's what we're looking for going forward here. But it was a good earnings season, not as bad as it could have been. A lot of companies are talking about supply chain issues, talking about Ukraine situation. A lot of them, 3/4 of the companies are bringing that up in their earnings report. So we're, as I said, we're 95% of the way through earnings season. We've got another 3 months here to digest it in the market that has found a pretty good low. So I'd like to talk about the technicals. We are financial managers who construct portfolios. We take a very active approach to monitoring the portfolios, but we adjust and make adjustments, whether kicking out a stock, bringing a stock in, increasing allocation of a sector, decreasing. We do that relatively, every 2 to 3 months on average. So, I watch the market like I used to trade. I used to trade on Wall Street. I used to trade for a living. Now I'm doing longer-term portfolio management. I still watch it. I don't know if I'll ever not wake up in the morning and check the S&P futures and watch it through the day. But a couple technical points, and I think the last show we were on, we were talking about some key levels, and I was going to update you on that. So that would be the last show. So this is the Nasdaq 100, and I'm not going to get too much into the gory details, but basically I said on the last show, watch the 11,855 level. Okay, it's these three zones right here, and I think I had a marker in there, maybe on the daily chart somewhere. Yeah. So this is the gory details of sort of the technicals I did in the hedge fund world. So all this means is basically a floor, an expected area of support about 11,800 and call it 11,800 in the Nasdaq 100. Now this isn't the comp, the Nasdaq composite. This is the NDX 100, the Nasdaq 100. So this zone of support, we're looking at a weekly chart here. So each one of these bars represents 1 week of trading. So this was the week of May 9th. Here's May 17th, and then here we are, May 23rd. And if I change this from bars to candles, you might be able to see a little bit more of what's happening here. So this was the pretty historic 1, 2, 3 week, 4 week, 5 week, 6 week, 7 week decline. But you can see we tried to get through this support floor here, 1 week, 2 week, and then finally the market just said, and it ripped higher. Okay, so we just closed 18 minutes ago. So the fact that we're squeezing higher heading into a holiday weekend can be problematic, but the fact that it happened here at support where it should have happened is interesting. Okay, so I also want to show you SMH, the Semiconductor Holders, sort of the same concept here, an SMH, the same kind of concept, which is down, up, down, that equality point. Okay, so actually just let me go back to the Nasdaq. I don't think I made that point properly. The reason that these two, and I'll go back to the semi, sorry. The reason that this was an anticipated support level is if you look at the decline here from November into March, it was 22.5%. Okay, we rallied back up here into March, and then guess what? We did a 23.9% drop. So roughly 23% equal leg moves down, and that happens more times than you think. And to get even more crazy here on Friday afternoon, the entire decline in the Nasdaq was 31.45%, 31.5%. COVID drop was 30.45%. Okay, so the market really does, it doesn't repeat often like this, but it rhymes and it has similarities in terms of past price behaviors. And when you combine that with a good knowledge of what's actually happening in the market versus what should be happening or what has happened according to fundamentals, which are mostly backwards looking, it's the combination of a technical understanding of what's happening on the chart and fundamentals that I think make you a good investor. Okay, so that's the technicals of the Nasdaq. Let me just show you SMH, Semiconductor Holders. There's been a lot of strength in semis recently. Semis really haven't been able to break too much through this 230, 225 zone. And what you'll notice is this is that same 100% move. So if we just take the percent drop here in semis, that was, let me just look at that quick, that was 25%. And the semis didn't even get to another 25% decline. It got to 20, yeah, close, 24.5. That's amazing. So there's a lot of it. I mean, you look at stocks like Microsoft, didn't even, okay, actually, no, excuse me, Microsoft did get to it, but it held it very well. Again, whatever percent decline that is, go back up, a little bear market rally, come back down. The equality of this percent drop, which is 29%, was equal to this. At 29%, we had one little day back here on May 20th that tried to break below it, and then boom, right back up. So no coincidence. Okay, it's not coincidence. So from there, we're going to number 2, which is going to be, let's talk about the Fed rate hikes. I found it problematic in the last few months when the market was convinced the Fed was going to raise. They said 10 times, 250 basis points, 300 basis points, which is 2 to 3%, and the federal funds rate. And I said, when the market is telling you, or analysts and pundits and whatever saying, this is going to happen, this is what the Fed is going to do, and the market was selling off, and I said, I've seen this before, and when somebody tells you the Fed is definitely going to do something, and that's general consensus, usually it doesn't happen. And I think we're starting to see that. So point of me saying this is everyone was convinced we're going to see a series of 50 basis point hikes. Okay. So if we look at this tool, so right now the current federal funds is 75 to 100 basis points. 0.75 to 1% is where the Fed is set the target rate. Okay, so this is now June probabilities of going from a range of 75 to 100 to 125 to 150. So that's 50 basis points, a 0.5% increase. We're at 96%. So we're getting 50 in June. And then we're going to go from, and I've got to remember these numbers. We're going from, okay, 75 to 100. After the June meeting will go 125, 150. And then July from 125 to 150, they're looking to go 175, 200, another 50 basis point increase for the July meeting. So we have 250, 0.5% increases over the next 2 meetings. But here's where it gets interesting. I don't think a lot of people are talking about this. So let me go back, and it's hard to keep it straight in my mind. Okay, so after July, we're going 175 to 2. If we're going to do 50, it should be 225, 250 range. But we go to September, 225, 250. 225, 250 is only a 36% chance. So in the September meeting, in the next 3 meetings, they're saying there's only 36% chance we're going another half, and the market is pricing in 58% of only a 1/4 point increase. That's not what we heard a couple months ago. And what's interesting is you look at these numbers here. So where was it 2 to 2 1/4? Right now we're at 36% chance. Yesterday 34. A week ago it was at 50. It's dropped by whatever 15 is a percent of 50, 1/3 roughly. A month ago it was at 52. We just got, in the last week, federal funds just came way off, okay? And the same thing of only going a 1/4, it was at 38 a month ago, 47% chance a week ago, and then it went to 60%. It's almost doubled in a month to go only a 1/4. So then if the new, let's say, is 2 to 2 1/4 into November, 225, 250 is the consensus. So we have a couple more 50 basis point hikes, and then the Fed's going to a 1/4. That's not what they told us. Last week, Kramer was on CNBC saying 100, do 150, all the way out. The market just scaled that back pretty considerably. So let me just check my notes here. Keep on track here. Oh yeah, let's take a look at tips. Treasury inflation protected securities. So this is an ETF that basically handicaps inflation, where inflation is expected to be in 5 years. This is the 1-year chart of this. So the Treasury inflation break-even rate gets a little crazy, but basically it's predicting where inflation is going to be. So that's March of 24, we're over 3.5% inflation. We have backed off to 2.8%. So the tips market is telling us that, okay, we're starting to scale back here. And that, I think the market is taking solace in that. Okay, we're going to talk about the economic data. That's coming up here. But let's talk about yields and yield spreads. So I'm going to get just a touch gory here in some of these spreads. We've talked a lot about it on this show about how the market went, and everyone on CNBC and all my friends, everyone was going crazy about 10-2 inversion. So the yield on the 10-year Treasury, you take that, subtract it from the yield on the 2-year Treasury. That's the 10-2 spread right here. Okay, and I'll just retell the story as quickly as I can. It got down, just let's go 1 year here. As this gets lower, as we get to 0, that's what's called yield curve inversion. That means the shorter yields, the 2-year yield, which is right here. It's gonna get a little dicey on this. Okay, the 2-year yield and the 10-year yield, the spread between those two, the 10s and the 2s are orange and purple here. As the distance between these two is narrowed, the spread between the 10 and 2 goes down towards 0. That's called yield curve inversion. That is supposed to signify that we have a recession coming when this blue spread gets down to 0. And if I go out to a 5-year, look at that. We had it back in 2017, 18. You go to 10-year, blah, blah, blah. You can see all that. Long story short, then people started to realize that it wasn't the 2s to the 10s, it's the 3-month that actually tracks where the Fed is going to go. So what they're trying to do is the market's pricing where 10-year yields are based on more free market forces. The 2-year, everyone's trying to say, represents what the Fed is going to do at the short end, but it's not that. It's actually the 3-month. Okay, so the 3-month is the 3-month Treasury, and if we take the 3-month and put it over federal funds, it's lockstep. So federal funds is everything I just showed you on that where the Fed is going to be raising 25, 50 basis points, which is 0.5%. So where the Fed sets the target interest rate is very closely tracked by the 3-month. And then if you just simply overlay the 2-year, 2s in blue, you can see there's a lot more sort of wiggle room divergence there. So it's the 3-month, 2-year. Okay, so it's the 3-month, I think, that tracks where the federal funds rate is going. So all that means is if we look at the 10-year minus the 3-month, that I think is the real indicator of if we're going to have a recession. And that needs to be, again, down by 0. Okay, we did get some inversion back here in 2019 as the difference between the 3-month Treasury rate and the 10-year got down below 0. That can be scary, but it's been straight up since then. Okay, and that is a good thing. That is a positive development in the market. Okay, we have come off a little bit, but you can see the 3-month over the 10-year. This is what makes up the spread. The blue, which is the 10-year, the yield's gone up, but what's happened is it hasn't gone up anywhere near as fast as the orange, okay, which is your 3-month Treasury. So the spread is getting wider again. That's good. That's the shape of a healthy economy. Okay, so that's that. Let's talk about the portfolio update here. We just rebalanced, and I'm going to show you what the new sector allocation is. We made some interesting moves, I think, more in the growth portfolio as the market has moved down into technical support, as I mentioned, as I showed you in segment number 2 here. Yeah, let's talk about that. I did forget to mention too, Ryan, he is not joining us here today. He is traveling and enjoying good time with the family. He worked this morning, I'm working this afternoon, so I'm obviously taking you through the show. Okay, so let's, what are we gonna do next? Portfolio updates. Okay, so let me bring that over. So let's talk tactical dividend first. Okay, so this is the sector allocations where we are right now. Okay, with our tactical dividend portfolio, which goes through a bunch of fundamental filters, but essentially has to have certain free cash flow, has to have a certain beta, volatility to the market, has to have forward current PE and forward PE, has to have specific revenue growth percentages on a 5-year basis. So on top of that, every stock that is held within these sectors has to pay a dividend. It's held up relatively well compared to the market, but these are the changes we made. We just rebalanced this week. We went through every client account. This is the adjustment column, and the most notables here are financials. We dropped financials pretty significantly. We dropped them by 8%. That's a big move. So we went to 11.25, which means we were close to almost 20%, which is overweight the S&P at 13.4. So we went to more market neutral, slightly even underweight on financials. And it's interesting, rates have been going up, but just what I talked about, inflation expectations are coming down. We're starting to see the bond market, fixed income, start to find a floor, bond prices going up, yields going down. Financials are starting to reflect that. And financials will do well in an increasing interest rate environment. They've already had their moment in the sun, and we have already seen evidence that financials are rotating out of favor. So it was time to ease up on that. Let me just show you that chart right here. So this is the software I use to watch the major sectors and sort of rotate in and out of favor relative to the S&P 500 benchmark. And you can see that the financials, this is the XLF ETF, began rotating out of favor, up here. This was in March. And then in all through March, and then we start going into April. And when you start moving down to the left, financials are falling out of favor relative to the benchmark. We have started to bounce back a little bit, but on this weekly comparison of the financials, the S&P, we've come off quite significantly. Okay, so that's financials. We've done a pretty good reduction there. We're just slightly underweight XLF there, financials in the portfolio. And of course, I'm not going to show the entire portfolio. Other moves, we reduced consumer discretionary. Okay, so we're at 7.25, about 3% underweight to the S&P for obvious reasons. With inflation moving up, companies warning specifically that retail oriented. We saw a lot those earnings reports out of Home Depot and Target and Lowe's. I mean, that was crazy. So we rotated out of consumer discretionary. That has been an underperforming sector. We saw a pretty good bounce back today, but I think that might be a little bit more short covering ahead of the long weekend. But we did reduce consumer discretionary, slightly underweight there. Reduce, the relative to the S&P. We reduced just slightly in consumer discretionary, but we're continuing to be underweight. And I did more in the growth portfolio, which I'll show you next. So big moves of financials. I reduced industrials a little bit and increased everything down here. We increased in energy, increased in real estate, materials, dropped utilities a little bit, increased in staples. So this continues to be, I think, a value-driven market specifically for this tactical dividend portfolio that we're showing you. So we dropped financials and industrials and basically increased everything else. Next one I want to show you is the New Age Alpha, which is our growth portfolio. We benchmarked this one to the Nasdaq, where that tactical dividends to the S&P. So this is interesting. In the growth, which we call, it's the New Age Alpha, we're pretty considerably underweight technology in this alpha portfolio by 14%. Nasdaq weighted tech is 48. We're at 34. We did kick it up a little bit to 1.7, but the big adjustments here in the New Age Alpha is we dropped consumer discretionary by 5.5%. We're 14.75% allocation, a little bit underweight compared to the Nasdaq. In communications, we dropped pretty handily. So we're underweight by 8%. We only have a 9% weighting. With Facebook doing what it's doing, Google has been okay. It's Netflix and the communications just massacred, even though they had good earnings report. Either their user and subscriber growth wasn't there. So comms just continues to be a mess. So we dropped it a little bit, but we're still 8% underweight. Financials we increased. Financials we dropped, still out. Overweight financials in the Nasdaq, which has hardly anything at all, only 1%. So we dropped 7%, a lot in financials, again, just like we did in the growth, in the value, tactical dividend value portfolio. So we adjusted industrials up a little bit, technology just a touch, but those are the major moves that we made there. But I think the most notable is consumer discretionary for obvious reasons. Financials, same situation, that development interest rates, that's reflecting the Fed, who is possibly telling us the supply chain is easing up. We might be getting close to peak inflation. We just got to watch the energy prices. That oil just continues to be very, very, very tricky. Okay, so that's the main takeaway here. Quick video. I don't even know how quick it was. I tend to not be quick, but hopefully that helps. We held technical support, positive developments. Oh, you know what I did forget is economic data. Economic data. Man, I got my list and I can't even, oh, it looks like economic data didn't even follow. That's fine. Okay, so let's do that quick and then we'll wrap it up. So the data, speaking of, we had PCE, personal consumption expenditure this morning. We'll talk about that. Let me see if I go right here. Okay, so this is this week's data. So on Tuesday, this what's kind of started it off. Everyone's like, oh, recession's here, new home sales. Came in 591K, expected 750K, plus you had a revision down to 709 from 763. That's a pretty big drop. 10%-ish drop from the prior reading, and we came in significantly under on new home sales. So a lot of people are saying recession indicator, potentially just an overheated housing market, labor issues, input supply, who knows. That house behind me that I'm telling you about, we drive it by every day, big beautiful new house they're building, nothing's happening over there. Okay, then Wednesday, durable goods, we had a revision down from 1.2 to 1.1. This was a pretty good miss at the core level. At the headline, we're expecting 0.6 and came in 0.4, so that's no bueno there. Preliminary GDP for Q1 was weak, minus 1.5 on 1.3, and I think that's part of the Fed scaling back on aggressive interest rate hikes. Where economy dropped more than we thought. The price index out of GDP was up slightly. Pending home sales, pretty big drop there again. A housing market indicating cooling off. And then we get pricing data today. The PCE, this is the headline, 4.9 was expected. This is year over year growth. The core was also in line at 0.3. Personal spending was up. So we actually take that as a good thing. Income was also up. It's not shown here. So basically in line, which wasn't too bad. And then there was another one in here. Consumer expectations. Oh, this is the one right here. No, consumer spending. Oh, this was the one that really got to grab the market's attention. The month over month headline PCE last month was 0.9. We dropped down to 0.2. So we dropped by 0.7% month over month on the personal consumption expenditure, and that's the Fed's preferred inflation gauge. So going from 0.9 to 0.2 is very encouraging. Okay? All right. My wife is looking at me. Got to go. Have a great Memorial Day weekend. Remember what it's all about in this crazy, crazy time. And, man, a lot going on in this world. But enjoy, friends, family. Have a great time. And I will see you guys. Ryan and I will be back on Tuesday. Take care.